Top of the morning to you traders. Hope you're doing well. Here we are, another day to get our teeth stuck into. Good morning, K-Man. Nice weather we're having at the moment, eh?
Morning, Ryan. Morning, everybody. Perfect weather for the hair growth, mate. We both need it. So said that rainwater promotes the hair to grow, you know. So
Really?
well, that's
Go on,
what
then.
that's what
I'll
our
let you guys
grandparents
stand outside.
that's what our grandparents were telling people anyway. So
Yeah, it's good weather for ducks and my fish. That's about it. But yeah, awful weather again. Oh, it's been terrible this year.
it is.
But,
And it's just
such
the
is life.
start of our autumn and winter. We're ready for the next 6 months of this year.
Yeah, 6 months. I buy 6 months at the moment, the way it's looking. But we shall see. Hopefully we get some snow this year. I like a bit of snow.
Oh yeah, I'd love to. So much better than wind and rain.
Yeah, and then we'll have even less excuse to leave our houses.
Correct.
Right, let's get stuck into things. Going through the headlines and bits and bobs that have been out. China is likely to cut loan rates further this year, according to Chinese Press Securities Daily. So keeping the theme ongoing there. Story out also out of China said they're ready to work with Australia to deepen the mutual trust. So further good news on relationships between those two developing. Might be a bit of small support for the Aussie dollar. I don't mean today, but I mean just generally. Over to Japan, and our mate Ueda was out with some comments in Parliament saying that the wage inflation cycle is gradually taking place, though it's still somewhat weak. He expects cost-push inflation to wane soon, so that's some of the short-term inflation pressures, energy and the like, to wane soon. We'll see if he's right about that. Hasn't been right so far. Says we don't necessarily need to wait until real wages actually turn positive before exiting YCC and negative rates. So a little bit of a hawkish slant there, but we've heard similar themes before. He says it may be possible to end the BOJ's ETF buying when there's no concerns over the risk of a sharp rise in risk premia. And then went on to say that maybe they are helping to prop up the stock market with the ETF buying, which is a bit no shit Sherlock comments there from him. Anything particular out of Ueda you picked up, Kay?
No, it's just like this continuing change of language, one word by one word. That's how he does it. That's how he decides to direct the Bank of Japan right now. So the maybe not having to wait for the real wages, but we've seen the market getting a bit numb to those kind of comments. This is now, I reckon we're in a phase where the market is saying that, well, show us the money, mate, and we won't react or trade much until they really change something. But as you say, I mean, word by word, this is ongoing. This process is ongoing, but yeah, I mean, there's not much else to say about it. We can talk about the weather every day, but I mean, it seems like he changes one word every week, and then to just justify if and when it comes, and in the meantime, leaving enough room to the government to fund their stimulus packages. It's quite funny, actually, that the JGB yields are quite a bit lower. We went up into the 90 BPs for a while, and now we're trading somewhere in the mid 80s. It's kind of I'd say half a surprise that we are back down here. Yes, they defended the 1% or close to 1% already once or twice, but still, it's I don't know where those 10 BPs lower come from, and the yen is still weak. The yen is still on the defensive.
Well, maybe finally the JGB market is actually trading like the rest of the bond market, rather than being this contained beast, if you like, with the YCC and everything. Because, you know, if JGBs were moving down while everything else was, other yields were moving up, then you'd think, yeah, what's going on now? But yeah, I don't know if it's just moving around with everyone else. You know, we've seen a bit.
And that's where I think the market says, like, okay, we won't be trading normalization until you really tell us that you are normalizing, right?
Yeah, exactly. Right, some good news. Well, if you can call it good news for UK inflation. The latest retail or grocery inflation from Kantar showed inflation coming in at 9.7% in the 4 weeks to the end of October. That's down from 11% prior. I say sounds like good news, but since when has 9% inflation been, or 9.7% inflation been good news anyway? But it's down from the some 17.5, I think, the high it got to earlier on this year. So it's going in the right direction. BOE's Bailey was out with a comment saying, we think policy is now restrictive. So reinforcing the pause mantra there. Says economic growth is very subdued. Also repeating that he expects inflation to come down quite strongly next week, and next week's CPI report. Again, that's a bit of a no shit Sherlock comment, because there's going to be a big dropout likely from the latest cut in the energy price cap that we saw at the beginning of October. So we'll see that in effect in the numbers, as I was pointing out well before. So Bailey's not any sort of soothsayer. We knew this was coming a long while ago. On the rate front, we're now apparently pricing 325 pip rate cuts next year. It was 2 as of coming into this week. So now we're pricing 3. So we're playing the game again. The rate cut game is well in the mix. Over to the Tower of Mordor and ECB and Kazakhs, one of the hawks, says we're holding rates to keep inflation falling. We can cut rates when it's clear that inflation has been beaten. Can't exclude the possibility that further rate hikes may be needed. Well, the hawks got a little bit of ammunition this morning. An ECB consumer survey on inflation saw one-year inflation expectations rise to 4% from 3.5%, quite a chunky uplift there. Further out, 3-year expectations remained unchanged at 2.5%. The ECB are all about inflation expectations, a big part of their makeup, as well as the forecast and the like. So that move up to 4% might induce a few more hawkish comments. I'm not sure when Miss Sunbed is speaking next, but she may touch on those expectations next time she does speak. Retail sales in the Eurozone, not much to write home about. Came in down 0.3% on the month, down 2.9% year on year. So a little bit softer on the month and not as bad as expected on the year, but still a bigger negative than last month. Italy retail sales also coming in softer than expected. So these are all September numbers. So we're heading into that all important retail period, the end of the year, Christmas and whatnot. So we need to see whether consumers still have some cash to splash or whether they're going to be tightening the pockets. Over in the US, we got some trade data out of those guys as well. Trade balance coming in, if I can find it. There we go. Trade balance coming in a little bit worse. Deficit widening. Went about 1.6 billion more than expected. On the activity front, though, exports were up 2.2% and imports were up 2.7%. So both producing positive numbers in those categories there. So seeing increased activity, as you can see from the amounts there. So that's good news, even while the trade balance widens or the deficit widens, there's still activity occurring in that. US consumer credit was out overnight as well, just saying we've been keeping a bit of a closer eye on. September numbers saw a return to growth, up 9.06 billion, not as much as expected, but turning around the drop of near 16 billion last month. The New York Fed also dropped their quarterly consumer credit or household debt report. Household debt was up 1.3% in Q3, now stands at 17.29 trillion. Mortgage balances rose 126 billion. Credit card balances increased 48 billion. Auto loans up 13 billion. Student loans up 30 billion in the quarter. Probably no surprise for the student loan thing, seeing as that all kicked back into play. A lot has been made of credit card balances rising, but for good reasons. It's being spun as that's being behind why consumer spending has been so robust. So not a rise in credit card balances because of anything bad at the moment, i.e. people using the plastic to make ends meet and get a few extra quid in the pocket. So that all looks a-okay from that front. Fed's Kashkari was out again, saying that economic activity running this hot makes me question if we've done enough. If inflation starts to tick back up, that would tell me the Fed's job is not yet done. Fed's Goolsbee says you have to look through 2-week movements of long-term yield rates. If long rates are sustained at high levels, that is most likely tightening. So he's on that bandwagon as well. Says we are paying attention to figure out what is driving long-term rates. You cannot answer what number on long-term yield equals enough tightening. He says the economy is weakening, so a little bit different to what Kashkari's thoughts are. Fed's Waller says policymakers are mulling what's causing the spike in long-term yield. So he's another one who doesn't know what's going on. In the scenario of rate hikes causing instability, the Fed has other tools. So that's going to be something if we continue to see rates or if they start moving higher again, what other tools they're going to pull out the bag to combat that. Fed's Bowman continues to expect that further hikes are needed. She backed the decision to hold rates in November and is willing to back hikes if the inflation progress stalls. Fed's Logan, inflation remains too high. The core question is if current financial conditions are sufficiently restrictive, and that's something Powell isn't yet willing to admit, that they're sufficiently restrictive. Resilience of the US economy surprised all of us, she says. Well, these are the guys who are supposed to be in the know. Guys and girls are supposed to be in the know. And it just shows you that they can be surprised as well. Right, just in some other news, European Commission is apparently going to endorse membership talks with Ukraine in December. They're going to have these talks in December, whether to begin negotiations on assessing or after assessing Ukraine's progress on reforms that are needed for them to apply for membership. So that's something that might play into things, you know, that's something Putin's been well against, A, them joining NATO, and B, them joining the Euro area, as that puts the enemies on his doorstep, as he would say. One other point, and funny enough, as Kay mentioned it yesterday, someone must have been watching the Flow show, the US Treasury issued its latest currency manipulators report and actually took Switzerland off the watch list, off the you're on the naughty step and we're keeping an eye on you. So they came off even despite all the moves that we've seen in their reserves and what they've been doing in CHF, the Swiss franc. Yeah, Kay, they must. We must have moles in here somewhere, or someone's watching our videos.
Definitely, one of them is watching us, and then Yellen went like, "Hey, bring out the report because we we have to answer those guys about what they say." It's the biggest joke that I've seen in quite a while. Taking Switzerland off. Watching China, but China is also not really on the monitoring list for manipulation anymore, where they kept they're fixing 1.5–2% below the market for bonds.
Yeah.
I don't know, mate. It's just a joke, really. One that is really going to be pissed off is SMB's Jordan, right? Because he had all those little middle finger memes up and answers ready, and he can't even reply because they took him off the list. So yeah, so apparently everything's cool. Nobody is manipulating anything. And then you do just to say something, they had to put Germany and Vietnam on some sort of a list. So, I mean,
Yeah.
okay, I guess we move on.
Do you think do you think them not really paying much attention to it, because it seems like there's even more intervention than normal? You know, you've got China intervening, you've got the Bank of Japan intervening, you got the Swiss doing what they do day in, day out. It
Yeah,
seems like more and more people are intervening, but they're just, the US is just brushing it under the carpet. Are they just taking note, do you think, of current market conditions and what's going on, and saying, okay, you sort of got a bit of a free pass due to
definitely,
how markets are going?
definitely. I think they are on this in this situation where post-pandemic they knew that they injected massive amounts of liquidity everywhere around the world, and perhaps if those countries likely um, could defend their case towards the U.S. Treasury. Remember the last year as well, the kind of green light that Yellen gave to the bank, to the MOF rather, to
Yeah.
intervene, right? And I guess countries like Switzerland and well, China is another thing, but countries like Switzerland probably had some sort of a green light. But then, if you look at the massive amounts that the FX reserve in Switzerland have come off, I can't imagine it any otherwise that at one stage the US Treasury is going to turn around to the SMB and says, well, you've had your moment now. Let's renegotiate, or let's discuss. The markets are not at risk of derailing, and now we should go back to normal levels. But I do think absolutely this report shows that there's been enough communication agreement between all the official instances to come out and say, well, okay, for now, you guys can do whatever you like, basically.
Yeah, and no reaction in Swiss pairs on
Zero.
Treasury
Yeah.
News. So yeah, that's probably the middle finger from Jordan in actions rather than voice. But
Yeah,
anyway,
we have seen the reserves come off last month again. Although, as I said, there must be some rebalancing there because the Swiss franc strengthened over the month of October. And then obviously, if you bring your forex reserves back into Swiss franc, your Swiss franc amount is going to be less. So I don't think they intervened or bought a lot of Swiss franc in October, because if you look like roughly Swiss franc strengthened for about 2.5%, then I think it's about 3.5% or so less in FX reserve. So there mustn't have been that much of stuff going on. But anyway,
yeah,
it's something just worth noting in case in the next, is it quarterly or so, or half yearly, those reports, in case in the next reports they're back onto the list. But
yeah. No, I think it's
stage.
biannual. Yeah, I think it's April, the next
Oh
one
yeah,
that comes
okay.
out. Yeah, every six
All right.
months, April, October, uh, whatever
All
they
right.
deem it. Yeah. So yeah, set your clock for April, mate. See if they're back on.
Yeah.
Right. So what's been going on in markets? Well, not an awful lot, but what has been happening might be significant. Late yesterday, we saw euro dollar having a little test of the 107 level. It's holding again. So technically, it's doing what it needs to do to confirm that this is just now a bit of a fake out. We're holding back below there. It puts us, unfortunately, back potentially into the wider range 105, 107. It's just nicked a new low today, and that's never a good sign. That shows you that the continuation of this down move is still going. My next level is around about this 106, 35, 40 area. I've got the stops on my 105 longs just below that. Don't want to give too much back on that one. If it does go through there, though, I'm going to be back to neutral and looking to play the edges and not messing around in the middle, because it does look potentially like we're going back in the box. Cables also continued a move lower. It put up a bit of a fight around the 122.60s, but as you can see, bounce is now limited to 123, and that was too tight a range. Something had to give. It wasn't the upside, so now it's the downside. It's not blasting through, but it's just maintaining the move, so we could expect to see a bit further downside. Not quite at a test of this broken 60s area, 62, 63, 64, wherever your line wants to come in. That'll be key. If we go up there, test it, hold it, then we're probably going to be heading down to 122 at some point and keeping this move going. Again, another one back in the box. Aussie dollar, the few guys and girls in our chat room, myself included, jumped on this one down into the low 64s just as it was holding around here. We again got a bounce, come up to one of the old levels around 64.50, couldn't take it out. Now we're heading back down again. Not quite getting back down to the lows of yesterday, so not quite doing the same as the euro or cable in that terms. A bit more support coming in for the Aussie. If we do get back down to this 64 level pretty quickly, I'll be a bit fearful for a break. I'll be less inclined to try heading back to my position particularly. And then we may be on for a bit of a further move lower, and then perhaps we're heading down towards the 63s, low 63s, mid 63s. Who knows? But for now, this one's just holding up a bit better than the others. Dollar CAD looking a bit similar to dollar yen actually at the moment, mate. It's on the creep, it's on the grind. You know, if you look at both these, it's very similar moves. Dollar CAD, dollar yen, just grinding back up again. Not rockets, but just pushing up a bit higher. We did have some big. What was the API last night? Was it a big build?
Yeah,
or big drop?
big build, like 11, nearly 12. Yeah, nearly 12 million barrels. Big build over there, and yeah. If I'm correct, today's data are delayed. I think Mark said something about that in the room yesterday.
Yeah, the EIA stuff.
Yeah, yeah, but that's one big build. We have seen a bit of distortions like that on either side lately. So yeah.
Yeah, so
noticing and seeing that oil finally broke through 80, 79, whatever the supports were, and we're back down. It's a move that I actually feel a little bit in the metals as well, but those are holding up much better. Yeah,
gold's holding up a little bit better. Maybe why that's helping Aussie keep up a little bit as well. It's not going as much. Doesn't look like a complete commodity move like we saw yesterday, so a bit of support coming in there for gold. This 1960 level looks like it's just a bit undecided what he wants to do here. It's not a huge level. It's one of those keep an eye on it type levels. You know, when we get up there, we sort of mooch around it. We're doing the similar here. Down here into the 30s, high 30s is another area zone that might become support if we get down there. But I think he at the moment uses as your pivot. If we can get back above this 60s area, hold it, then maybe we're going to get another push up towards the highs. There's a couple of us in the room wanted to have a sniff of shorts into 2000, but we were a bit late to that one, so we're not on the bus with that. But I think if we get another move up there and it's not hugely risk or headline related, I might have a little short up there, but otherwise another one that's potentially back in its box, and then you got to just look to playing the ranges mainly. Okay, you got any? I've not got much. It's been a day, one of those days.
Today we're going to keep it very light, right? Because basically I can take it if you want, just for just to show a couple of things, but it's going to be very, very light today because we basically are, if you can stop sharing, so I can take
a tick. 1 second.
We basically are still very much trading on the one hand those differentials, but look at in currency terms, we are in the middle of those spikes. Okay, so this is what weighed the cable back down, and now we are stabilizing here. Those are the differentials. The European European and US are back into the box as well. This is your correction in the euro dollar. And then I've actually just stupidly made some calculations here, but I shouldn't, because the FIB still be enough. Around this 106 35 45, it's just coming back into neutral about in between the moves that we saw lately. And that is really what we are doing here right now, is that we had a try to the downside. Then we had this violent correction when the US yields came back down. And now we are seeing on the differentials that the rest of the yields are catching up. And if you look at, for instance, this is a page, one of my pages, look at the sterling yields coming back down, Canadian yields coming back down, Australian yield coming back down. And as we've already mentioned, even the yen yields are coming back down. So we are basically just correcting everything that has been done, So where do we want FX to break anything? I can hardly see it unless we're starting to move out of those boxes or ranges in the differentials, because even if you look at the euro dollar, it tightened quite a bit when the US yields came off, but then we just came back to those prior differentials, right? And now we are getting back, and your euro dollar is back in the range. Same happening with cable, albeit, as we've already said so many times, sterling is a bit of a faster mover, so that has a bit of an impact on your euro sterling, which was looking a bit weak. But then we again 86.5 around came in as a support, and we're already trading back above 87. If you really a bit like me for now, if you don't know too much what to do with the dollar, you can have a bit of scalps here and there, but crosses are sometimes interesting in those kind of markets where we are trading ranges, right? One that I like still to look at is the EURUSD, for instance. It caps in those mid 166s. We're trading around 166, the figure, which is a bit of a neutral zone, but I still think there may be a case of revisiting first on down here those prior lows, which are actually a very, very decent support now. Okay, if you look at that, also in the past, decent support, but I do think in some way, for as long as equity markets don't come off, for as long as, and that's a bit of a risk, commodity markets don't completely collapse, there is perhaps a case of going for another revisit here, for as long as we are below those mid to high 166s. So I mean, if the dollars don't show us too much of a way, crosses can be something that you can have a look at. For instance, Euro Canada broke up, maybe a retest about in the mid 146s, and then look for the other way again. But just last but not least, Ryan was talking about those 1960s. I still think is those low 1950s really in gold, but okay, give and take $7-8, that's where we are, and you are in the range. I thought we would have a bit of a similar one than what happened in oil, banging our head against certain levels, and then see a deeper correction, perhaps back down in the low 19s. But has to be said that gold is holding up much better. If it's a delayed effect, if we get a delayed effect in this market, then watch if we start to break 52, 54 in gold, because then all of a sudden we could accelerate, okay? And really, let's keep it to that. I don't have much more to say. I am really scalping rather than anything else. I don't have a firm direction on what I'm doing, on what's to be done, actually. Back over to you,
Yeah.
right?
Yeah, I think I'll just grab the screen just for the sake of having it. Yeah, I took my Aussie trade yesterday because I was going through my charts thinking, what do I fancy? What do I fancy? And the only one that really showed that it might be on a level, based on my charts at least, was that Aussie dollar just down into 64. That was the only reason I took that trade. I was looking at dollar CAD, looking at euro. Don't fancy messing around with cable in 122s. Don't fancy messing around in euro dollar in below 107 while it's mooching around. So yeah, it's just, I think it's a case. We've had these big couple of weeks, all these events, whatever. We've had some volatility in that. Now we're seeing probably just a little bit of a breather happening in volatility just after those events until we get the next ones. And so what you're going to get is a bit of ranging. You need to just pick your levels. Look at where you want to trade. Would I want to trade cable around here when we're basically back in the middle of this? No, but I might trade cable if we have another look down to those lows 121 where we've got a bit of support, where we've got something to lean against. And again, now we've confirmed again this one up towards the 124.50 area. That's somewhere to think about if we get a move back up there. But in there, no, I've got no interest. So I'd rather sit on my hands, protect my capital, and then just wait for the levels to come to me. So sorry, we haven't got too much to get into today, but that's markets for you.
Yeah, I just wanted to add, we're a few of us in that Aussie trade. I went out and then back in because of what I saw in the dollar, and when I just went actually back in, it's a pretty clean trade as well. Your risk is, and those are the kind of trades we like to do, even inside ranges, because your risk is very clearly defined. If it goes back below 64, 63, 95, 90, I mean, there's no use to even keep it. And in the meantime, if we can trade it around and make it a free trade, which is my case right now, it's all the better. And if it goes up a little bit again, take some off, and there you go, trade it around, job it around a little bit. That's a pretty clean trade actually. If it breaks down over below 64, 390, it's easy, right? The stop is easy and not too far away.
Yeah, maybe even worth considering flipping it into a short if it breaks through 90.
Yeah,
and just having a little go on the downside and see where it goes from there. So yeah, as long as you've got, as Kay says, as long as you've got nice clean levels to lean against, that's a big solid level. We go back to cable. Yeah, we got a bit of a level 122.60, but it's not as big as 64 in Aussie dollar. It's just a minor level. That may or may not do something. So I wouldn't trade that, but I'd trade something that looks a bit more solid. And the battleground, need to get above 64.50, or you need to take profit off the table. And if we test back here, it needs to hold. If it doesn't, then you need to get out your trade maybe and look to try the other side, and then see if 64 becomes resistance, and boom, then you've got a shorting. Doesn't matter about bias, doesn't matter what you think of the Aussie economy, US economy, anything like that. There's your numbers. Its price can only do one thing, go up or go down. And that's a bit of a quiet show today, but it means we can all go get on with getting our heads in the rain and growing that hair, as Kay seems to think. So we will call it a day for today. Have a great day, everybody, and hopefully we've got a bit more to get stuck into tomorrow. Thank you, as always, K-Man, for your input. And, we shall see you all bright and breezy tomorrow. Thanks all.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.